Good morning. Welcome to Trading Hour, the last trading day of 2024, and things are not looking so bright. In fact, it's looking red, down about 1/3 of a percentage point. The only good thing is that after the gap down opening and the sell-off that we had in the initial part, it's not gotten worse. So we're still around, 23,000, 580. In fact, there has been a little bit of a recovery from the day's low because we went down to levels of even 23,500. Midcap still down close to about 0.5%. IT has taken a big knock today. The Nifty IT index is down over 2%, and the advanced decline ratio right now, at least, is in favor of the declining stocks. Hi.
Good morning, Rima. You encapsulated very well, given the fact that there's been a brief recovery after the kind of sell-off that you saw, especially in the first hour. And it's actually been the pharma stocks that have actually managed to help the entire market pull high. All of the pharma stocks now near the day's highest point. So, just looking at the market setup, very volatile trading session like it's been in the last couple of trading sessions, but markets have managed to rebound off the day's lowest points, even the Bank Nifty for that matter. In fact, the top Nifty gainer today is actually Kotak Mahindra Bank with gains of almost 2%. Now, the other section of the market that's seeing very divergent trends today are the exporters or the rupee sensitive, something that you just alluded to. So while IT has been a very big drag, it's actually the pharma index that's holding out in the green, and most of the pharma stocks today are doing quite well in the session. In fact, names like Sun Pharma, Cipla, Lupin, all of them are trading with gains. From the broader end of the markets, one particular stock that's seen quite a bit of a sell-off is Ease My Trip. The block deal of almost 14% doesn't appear to have gone through fully. Only around 1% or a little more than 1% has gone through, and that stock is now down almost 6.5%. From the broader end of the markets, names like Wrights, NBCC, Reddington, these are the names that are doing quite well. So overall, very choppy trade, and pharma is the only segment you could say is actually holding out in the green.
Pharma has had such a good year and towards the end of trade, even the rupee depreciating has acted as a tailwind. But there are individual stocks in pharma where there is positive news. So Lupin is one stock, and we should pull up Lupin because they have entered into an agreement with Eli Lilly for diabetes. And we know diabetes is a big problem in a country like India. So to talk more about it, and Lupin is up close to about 2%, we have with us Vinny joining in. Vinny.
Yes, this is a big drug that is coming from Lupin in terms of adding to the diabetes portfolio from Eli Lilly. They have purchased this drug. Now, this drug mainly currently, when you look at Lupin's diabetes portfolio, Q2 FY25, then managed to see a 19% growth on a year-on-year basis for the diabetes portfolio versus the industry growth of 9%. So this surely will boost their portfolio in terms of the diabetes side portfolio for the company. Now, other than that, the important news flow that came in overnight and yesterday was also that Teva and Amneal, these are two companies that are involved in a drug called generic Pro Air. Now, this drug, mainly there's an issue going on between these two companies. So with that, even Lupin actually sells this drug. So it's a positive that, when Teva and Amneal, the launches of their drugs are going to get delayed. Now, because of this delay and because of the issues going on in the US District Court of all these companies, this benefits Lupin because now the delay of the drug launch by these two companies would benefit Lupin, and they will continue to gain in terms of the market share, and the sales for this product will continue at least till Q1 FY26 is what analysts have also highlighted. So MK has maintained the buy rating on this one for Lupin because of this issue as well. Surprising positive move coming in on this front for the company.
Thank you very much for that. Ashoka Bilcon is also in focus. Vivek, what's the update?
Well, that's right. So Ashoka Bilcon, just prior to market open around 8:50 is when the company updated the exchange. Just remember earlier, the company had sold quite a few assets from its BOT portfolio, that's the Build, Operate, Toll portfolio, to another entity. But today, the development was that the company, along with its subsidiary, has sold close to 11 SPVs, that are special purpose vehicles that actually have HAM projects, which is hybrid annuity model projects. And this particular stake sale has been done to funds that are managed by Edelweiss Alternate Asset Management, or now known as Edelweiss AAA. Now, this particular stake sale has been done at a valuation of close to 2,324 crore, and analysts tell us that this particular sale indicates that Ashoka Bilcon has managed to recover almost 2 times, or close to 1.8 times the original investment. Now, this particular stake sale is subject to a few approvals, and the approvals need to come, number one, from the lenders to the SPVs, NHAI, as well as the Competition Commission of India. All of the 11 projects or all of the 11 SPVs, barring one, actually have achieved commercial operation date. Only one is still under construction. So it's a positive development for Ashoka Buildcon, making close to 1.8 to 2 times the original investment and also divesting the entire HAM portfolio.
Okay, and as we step into 2025, CNBC TV18 is asking some quickie questions. So how will the Nifty perform in 2025? What are the sectors and the themes to bet on? Will the faltering GDP growth revive in the next year? And will the RBI start cutting rates? We will ask the experts for you. So stay tuned for the most comprehensive market poll tomorrow on CNBC TV18.
Welcome back to Trading Hour. Well, with Bitcoin crossing record highs of $100,000, President-elect Trump has taken a pro-crypto stand and more countries are accepting cryptocurrencies as legal tender. 2024, therefore, has been a breakthrough year for cryptocurrency. Manisha brings us more on how the world of cryptocurrencies has evolved in 2024 and what to expect in the new year.
2024 became a landmark year for cryptocurrencies. Bitcoin smashed through $100,000 mark to hit all-time highs at $108,000, surging 130%. The crypto market cap also hit a record highs of $3.9 trillion. The year 2024 started on a very high note with launch of Bitcoin ETFs, which gave an easy access to individuals and institutional investors without the complexities of wallets and private keys, accumulating more than $110 billion of inflows. Ethereum did not lag too far behind with ETF inflows above $2.7 billion, making its place in decentralized finance. Well, the institutional investors now own 20% of all Bitcoin ETFs traded in US, and then it was Bitcoin halving, an event that happens every 4 years. It leads to reduction in the block rewards by 50%, lowering the supply of Bitcoins. And then it also was about rally taking wings after the US President-elect Donald Trump's pro-crypto stance. He has pledged to make US the crypto capital of the world. He also suggested that the US Bitcoin reserve could be a possibility, and there was also a discussion of using Bitcoin as potential tool to repay the US debt. Trump also has nominated Paul Atkins, who's a known crypto advocate, to succeed Gary Gensler as the US SEC chair, which the crypto bulls have totally cheered, expecting favorable regulations going forward. Well, then you had the Russian President Vladimir Putin also recently saying that no one can prohibit Bitcoin, showing support for cryptocurrencies. The approach from Poland, Italy, and even China showed signs of revisiting previous critical policies. And then, after El Salvador, countries like Tonga, Paraguay, and Panama are now considering adopting Bitcoin as a legal tender. Well, the cryptos also are taking support from wider adoption of real-world assets. Stablecoins are emerging as payment tools for enterprise businesses. The year 2024 also had its share of frauds, hags, and rug pulls. The sector lost nearly $2.3 billion in 2024 in frauds, which clearly is lower than the last year, but nonetheless a big amount. The names that went through these issues were WazirX, Radiant Capital, DMM Bitcoin, among many others. While the Bitcoin grabbed all the spotlight, altcoins also delivered significant returns. Tokens like Solana, Ethereum, Ripple, Cardano have all hit all-time highs in this year. While lesser-known altcoins like Palm AI, Mantra surged anywhere between 10,000 to 20,000%. Well, in the past year, meme coin market capital also was in favor. Market capital hit $113 billion, led by Dogecoin and Shiba Inu as per CoinGecko data. 2025 shows a lot of promise for cryptocurrencies and also blockchain as a technology. The markets have put even higher targets for Bitcoin for 2025, with Standard Chartered and Bernstein expecting $200,000 for Bitcoin. MicroStrategy expects Bitcoin to rise 29% per annum for the next 21 years. But remember, it's a volatile space with significant risks. With so much unknown about projecting its future returns, it's always pays to be cautious.
Indeed, wise words. Thank you, Manisha, for that. But now let's turn our attention to the defense space. Now, defense has been such a structural theme of our markets over the last few years, and many investors point out that perhaps it's got a long runway. Now, Care Edge Ratings, in its recent note, says the Indian defense sector is set to grow at a compounded annual growth rate of 20% over the next 5 years on the back of strong government backing, increasing private sector participation. They also anticipate India's defense exports will grow in tandem with government spending at an estimated rate of 19% from FY24 to FY29. We have with us Dr. Naveen Kumar, Associate Director at Care Edge Ratings, joining in. Naveen, thank you very much for joining in. So first, tell us the crux, the key points of your research report. 20% top-line growth for the industry for the next 5 years?
Yeah. So, we expect basically what we see is that both, the government and the private participation has been constantly increasing in this particular space. Especially, what we see is that since gaining up the independence in 1947, India has gradually transitioned from relying on the imported military hardware to enhancing the indigenous defense capabilities. This shift is driven by the domestic manufacturing and the technology transfer agreements. Today, defense sector includes both diverse mix of public and private enterprise involved in various aspects, such as from defense to research and development. And apart from that, we also see that India's defense budget has consistently ranged between 1.9% to 2.8% of the GDP. And in the current year, we see the fiscal outlay of about 6.22 lakh crore. And for the defense production, it is about 1.75 lakh crore. So based upon this, we understand that the defense sector is expected to grow by about 20% going forward for next 3 to 4 years.
What is the percentage of indigenization right now in the production, and what was it earlier? If you could just talk about that.
Earlier, primarily the country was a net importer, but what we see is that there was a concerted kind of an effort which was made by the Indian defense industry. Especially, it was supported by the policy reforms such as Make in India, which is bringing about the gradual shift. Today, India boasts an expanding defense industry encompassing wide range of advanced military weaponry systems. India's defense include diverse array of aircraft, naval systems, missile technology, and all. So what we see is that over the last 6 years, ending in FY24, the Indian defense exports have grown at a healthy CAGR of about 28%, and the carriage estimates that the India's defense exports will consistently grow in tandem with the government spending, that is about 20% going forward.
Naveen, so you've spoken about two important aspects. Number one is the own Indian government spend, and then number two is the export opportunity. Now, talking about the Indian domestic market, where do you see the key opportunities lie? So what kind of companies will be more benefited, and what is it, do you feel, in the next AON, that is the acceptance of necessity, will you see what kind of weapons do you feel there will be need for further spending on?
See, we have got, when it comes to domestic companies, so there are now about 4 to 5 key players, key companies which are making this effort. One is Bharat Dynamic Laboratories, and there's a HL, there's a Mazgaon is there. So these are the main entities. Apart from that, the Ordnance Factory Board, comprising of about, which is currently divided into seven corporates. These form the critical in terms of the domestic defense public sector undertaking companies, which form about 80% of the entire defense industry. Whereas when it comes to the private sector, there are about 4 or 5 players are there, which comes from the Tata Group, L&T, Mahindra Defense, Kalyani Group. These all play a pivotal role in advancing the defense modernization, leveraging their engineering technological expertise.
Okay, so you've spoken about the improvement as far as the expertise is concerned. Now, coming to a name like a Bharat Electronics, where there have been multiple one-time opportunities, do you feel that there will be a lumpy nature as far as order wins are concerned, or do you see that there can be steady order wins, especially when it comes to defense spends? H1 especially was quite muted when it came to orders actually coming in.
See, what we see is that the Indian government has made an estimation of reaching its defense production to about 3 lakh crore by FY29. So what we say is that in order to achieve this kind of growth, they have to make a CAGR of growth of about 20%. So in that context, if I have to say, then there may be during one specific quarter, there may kind of be lumpiness, but we see that overall there will be kind of growth prospects are going to be very healthy. for all these companies which are there in the public sector undertaking.
Any particular stock analysis? Have you chatted with the companies? Because earlier there was some concern that the execution may not keep up.
Oh, sorry, execution?
Execution on the end of the companies may not keep up. We may see a lot of order win announcements. But in terms of that translating into revenues or just the pure execution may not keep up with the kind of headlines that we get.
See, what we understand is that, especially when it comes to the DPSU part, there is a kind of dependency on the certain import of certain key raw material from the Russia and all. So what we have seen is that because of the geopolitical issues, these imports have been to some extent been inhibited. Because of it, there's a slight delay in terms of the execution. However, with the subsiding of this geopolitical tension to some extent, now we see that the execution and the production has been on track. So what we see is that going forward with the increase in the indigenization within the domestic market, this the lumpiness or the crests and troughs are going to even out going forward is what we understand.
Naveen, one last question from our end. What we want to understand is, especially in the case of a name like HAL, which is, in the process of manufacturing the LCA or the light combat aircraft, they've been dependent on supplies from someone like a GE. And this particular delay has caused significant waiting as far as the investors are concerned and as far as the revenue booking itself is concerned. You did mention about supply chain challenges. Do you see this continuing, in the coming years as well? And how do players overcome this?
With respect, I abstain from making a comment company specific. So while we overall, what I say is that not only for the HL, overall the industry, whether it is like BrahMos, whether it is for JV with both India and the Russian government, and also the ordnance factory boards where they have got partnership with the Russian entities and other countries, we see that there is some kind of supply chain issues which are taking place because of geopolitical issues. But what we see is that this is not a kind of a sustaining factor, this inhibitions factor which are playing out. So overall, what we're seeing is that though there is a kind of lackness is there in a H1 or probably 1 or 2 quarters or 3 quarters, but eventually it is evening it out. So that's why I was saying that this crescent troughs are going forward is going to significantly even out, and we are going to see that much more dynamic is going to play in the domestic industry, defense industry, especially with the private participation coming in. This particular industry is definitely going to grow by about 20%, what we envisage.
Thank you very much for joining in and wish you a very happy new year. Get into a break. We'll come back and talk technicals. Avni Bhatt of JM Financial Services will join in next. Welcome back. The biggest sectoral loser today is IT. The Nifty IT index is down close to a little more than 2%. But this comes on the back of a 21% rally that it's had in 2024. And even last year, in 2023, the index had given more than a 20% up move. Largely what you are seeing is profit booking. So names like Persistent, Oracle Financial Services, which has been a big wealth creator, Coforge has been a big outperformer. The biggest cuts are visible in those names, though there is a Persistent as well, which is down 3%. And that's not had such a great 2024. In the large cap space, again, it's a broad-based sell-off. Infy, TCS, across the board, you are seeing pressure today. TCS is down 2.5%, and TCS has underperformed Infosys. So year to date, TCS is up 7%, while in Infosys is up nearly 20%. And there's one concern on the street is that the revenue growth of TCS X of the BSNL deal has been lagging that of the industry. So the street is a bit concerned, and even the kind of margin recovery that the street was hoping for has not played out. So that's one of the reasons why TCS has been an underperformer compared to Infosys, and Infy's growth has been higher than TCS for the last 2 quarters and likely to be higher even in Q3. But let's talk about the market technicals. Avni Bhatt of JM Financial Services, as promised, is with us on the show, and the little bit of a feeble market recovery continues because the Nifty is now closer to 23,600. Avni, how would you approach trade today?
Good morning, everyone, and season's greetings to all of you. So yes, Nifty, Bank Nifty, both of them did not seem to be in a mood to celebrate the New Year's Eve. But probably we could see some more recovery by end of the day. Yesterday, Nifty had given a close below the 200-day exponential moving average, and the follow-up sell-off was seen by way of a gap down opening today. But since then, since opening, I don't think we are seeing any more further selling from those levels. So a selling climax is done. From here on, if at all Nifty closes about 23,540 today, then I think today's low would be the bottom for the time being. And we should see a good recovery up to around 23,850 to 23,900. That is one area where a lot of resilience is seen. And on Bank Nifty, 50,700 is a very, very crucial level. Bank Nifty, if you notice since last couple of sell-off periods, Bank Nifty has been holding on to its 200-day exponential moving average. So the chances of recovery in Bank Nifty are way higher. 50,700 is the level to watch out for. If it closes above that, then we will be seeing a good recovery up to around 51,400 in a very short time, in coming probably 1 or 2 days.
Avni, very good to hear that you feel that there's an interim bottom in place as far as the markets are concerned. Now, one particular question, have you had a chance to look at the Nifty IT index? Do you feel there could be further downside there? And what are your individual picks for the day?
So Nifty IT, if you notice, if you notice the rally from around 40,000 level to the highs of 46,000 level, from there on, we are seeing a good profit booking happening in this particular sector. And the 61.8% Fibonacci retracement is already done. So I think from here on, it should consolidate for some time and then probably see some pullback. But the pullback is going to be slow and steady. So not expecting any major fireworks in the sector, but the downside should halt and it may consolidate from current levels.
And any individual stocks that you want to suggest to our viewers?
So one sector that has been performing very well is the pharma sector, and among the entire pharma sector, I think the stocks that have not moved and are ready to move on from here, one of those stocks is Glenmark Pharma. So I have an eye on Glenmark Pharma. One can buy in the range of around 1,600 for a target of 1,735 on the upside, and keeping a stop loss of 1,555. The second counter on radar is MGL, Mahanagar Gas. So one can go long in this particular stock for a target of 1,380 and a stop loss of 1,255.
Thank you, Avni, for joining in. Let's move on and talk about Mazgaon Docks. That's in focus on the back of a near 2,000 crore order win. Upasana is here with the details.
Well, that's correct. The stock continues to remain in focus today as Ministry of Defence has signed contract valued 1,990 crore with the company for technology that allows submarines to stay underwater for longer. Now, this is mainly for the construction of AIP system, that is Air Independent Propulsion System, developed by DRDO, and the units will be built by Mazgaon Dock. That's the reason the stock remains in focus today.
Thanks so much for that, Upasana. Mazgaon Dock in focus on the back of that particular development. Let's now take a short break. Up next, we'll discuss the way forward for the market with Devang Mehta of Spark Private Wealth Management. Welcome back to Trading Hour. Well, as the equity market looks ahead into 2025, Surabhi gets us 5 key factors the market will be looking out for as we move into the new year.
From geopolitics to global trade to the economy and interest rates, there's a fair amount of uncertainty and plenty of moving parts as the stock market welcomes the new year. So let's boil it down to the 5 major factors that will drive markets in 2025. Number 1, the US economy. Will America be great again in 2025? American exceptionalism became a catchphrase by the end of 2024 as Donald Trump swept the US election. It was all about the great return home trade again. Contrary to fears of recession, the US economy roared solid in the year with the third quarter GDP at 3.1%. The main issue before markets now is the shape and form that Donald Trump's economic policies will take on three key aspects: tariff increases, extension of the 2017 corporate tax cuts, and any changes in immigration policy. On tariffs, the world is holding its breath. Some, like UBS, feel that the impact of the 60% tariffs on China will be felt only by 2026. That is, if these kind of tariff increases are announced to begin with. Wall Street is elated with the likely extension of corporate tax cuts. But Bond Street is already showing its displeasure with the rise in US yields. Which brings me to the second big factor to watch in 2025. The US Federal Reserve rattled markets in mid-December by announcing that it will probably deliver just 2 rate cuts in 2025 instead of the previously projected 4. The reason? Solid economic growth and sticky inflation. US GDP growth expectations range anywhere between 2.1% to 2.5% for 2025, even as inflation remains sticky. The Personal Consumption Index, which is an inflation measure that the Fed closely monitors, grew 2.1% in September, 2.3% in October, and 2.4% in November, well above the US Central Bank's 2% target. Now, what is also forcing the Fed's hand is the expected inflationary nature of Trump's fiscal policies and the massive debt that the US government is already running at close to $36 trillion at last count. Now let's move to the next piece of the puzzle, China. The dragon is gearing up for a potential tariff fight with Uncle Sam. China is expected to run a budget deficit of 4% of GDP next year, which will be the highest on record. The number was 3% in 2024. PBOC is expected to cut rates in the coming months, and it may also allow the yuan to weaken to boost Chinese exports. All this while the country most likely retains a GDP growth target of 5% for 2025. The official estimates and policy action will be announced only by March after the country's parliamentary meeting. Markets will wait to see if the fiscal and monetary stimulus will indeed be the real deal this time. The announcements are likely to keep markets volatile, with traders hunting for lucrative short-term trading opportunities. Coming to factor number 4, India, our macroeconomic story and slowdown fears. The 5.4% second quarter GDP print has led to a big clamor for bigger policy response. The street is expecting the new boss at RBI, Governor Sanjay Malhotra, to usher in a rate cut cycle starting early 2025. The problem, however, is inflation. While November CPI inflation cooled off to 5.48% from a red-hot figure of 6.2% in October, the RBI does expect inflation to remain sticky. It raised the full-year FY25 CPI inflation projection to 4.8% from 4.5% in the December policy itself, while cutting the GDP growth forecast to 6.6% from 7.2% earlier. The RBI will also have to keep a tight watch on the rupee, which has depreciated past 85 to the dollar in the middle of December. What could offer some comfort to growth is the widespread belief that government spending will pick up in the second half of this fiscal year, having contracted nearly 16% in the first half. The government has spent just about 37% of its budgeted capital expenditure, so the second half optimism is perhaps well placed for now. Finally, we come to factor number 5, earnings and fund flows, the fuel of any bull market. Corporate earnings growth moderated sharply in the first half, with the Nifty earnings rising just 4% in the second quarter, which is the lowest in the last 17 quarters. Most brokerages expect single-digit Nifty earnings growth in FY25. Motilal Oswal, for instance, expects just 5% growth. Hopes are pinned on a pickup in government capex, as well as a rural recovery in the second half. The street is, however, divided on the outlook for the coming year. Morgan Stanley expects 18 to 20% earnings growth over the next 4 to 5 years, led by an increase in private sector capex and a structural rise in discretionary consumption. The firm expects the Sensex to rise 14% in the new calendar year 2025. Jefferies, meanwhile, is more measured in its optimism. While it expects the rise in the government's populist spending to support consumption, it sees the massive IPO rush and block trades as an overhang. Jefferies warns that large equity supply has been exhausting domestic liquidity, and retail flows may actually slow down in 2025. The brokerage has a December 25 Nifty target of 26,600. Now, this heavy equity supply is a concern for Macquarie as well. The firm does not rule out the possibility of a 10% correction in the market in the first half of 2025. Now, 2024 has been a watershed year for the Indian market when it comes to retail participation. Mutual fund investors pumped in over 3.5 lakh crore rupees in equity funds this year, offsetting the heavy FPI selling that we saw in October and in November. While most on the street believe in the Indian market's long-term potential, it is this faith and resilience of the ordinary Indian investor which will probably get tested in the coming year, one that is likely to be more volatile and confusing than the near straight-line returns that we've seen since COVID.
Wow, that was very well explained and put, Surbhi. But let's get in Devang Mehta from Spark Private Wealth Management. He's a perfect person to talk about Outlook 2025. So Devang, let's start with, I don't know if you had a chance to listen to what Surbhi was telling us, but the first factor, right, to watch it will be the US markets, the US economy, and whether, the kind of dizzying rally that US markets have enjoyed for the last 2 years will continue. In 2 years, the S&P 500 is up nearly 50%. So what happens to the US markets from here? Because that's the base case, because their valuations are stretched. There is that Trump trade tariff risk as well. And what if the big, the fabulous 7, magnificent 7 stocks don't live up to that AI hype? So there are those challenges on board. How would you approach the global markets as a top-down call?
Morning, Rima. Thanks for having me on the show, and season's greetings to all of you. In advance wishes for a happy new year to all of you, your team, and your viewers as well. Yes, I think clearly while this is the last day of this year, reflecting on to what happened in 2024, and ideally I think the last 3-4 months have been so eventful that it takes us to 2025, and I think the start of 2025, we all know that we need to welcome Mr. Trump, and I think the policies that probably lays down over the next 2, 3, 4 months would be I think with a lens markets and market participants across the world will sort of look into it. Now, yes, probably we know that India will not be sort of not a beneficiary of what happens. China, yes, can be a little bit more non-conducive for China than India. Clearly, I think most importantly, you rightly talked about the valuations in US, right? So US valuations, everybody knows by any stretch of imagination are stretched. Now, I think there is a choice that yes, there was a home trade which happened, money flowing out of emerging markets going back to US. That trade is playing right now, and we don't know, probably it might play for a quarter as well. But I think at some point, at valuations which are right now being attractive, we know that the earnings were not so great. There is a contraction in terms of valuation as well, price correction as well. I think at some point we are starting to look a little more attractive than US. Even a lot of emerging markets, be it China, be it India, will start looking attractive. And at that point, the flows would tend to come back. Again, I'm no way saying that it will happen sooner. But very clearly, I think US markets are stretched. Their valuations are expensive. It's a trade which can still last for the next 6-9 months as Trump comes to power, and business policies might be conducive more for US. But the trade is that probably at valuations in hindsight, 4-5 months down the line before right now, I think our valuations were stretched. But after this correction of 12% and stocks correcting by 15, 20, 25, 30% also, I think our markets are getting more attractive than US.
Right. Devang, very interesting point you've put out there. Well, you've also spoken about currency volatility, and Indian currency, or the rupee, has been weakening quite significantly. In that backdrop, 2 sectors we want your opinion on. Number one, how do you look at IT from this point on? And it's been quite weak, especially in today's session. And how do you look at pharma, which has been doing quite well as far as last 2 to 3 trading weeks are concerned?
I think interesting that currency, I just made a point that Indian currency has been relatively stronger if you compare it to the other pack, emerging market pack. And of course, it is more of a dollar strengthening than rupee weakening, which we have seen. Yes, coming back to the sectors that you asked about, we are very positive on the domestic centric sectors. Having said that, IT, pharma seems to be coming back with a bang. IT still seems to be a trade which can generate 10-12% type of returns over the next 2-3 years. The typical large cap IT boys, we know that the constant currency growth and all are probably very, very low single digit. There might be some bit of improvement as the global arena comes back, as demand comes back, and there are more spendings on discretionary as well. So that might come back. But honestly, to tell you the truth, we are more positive on domestic-centric stories than the global linkages or the export-related stories, where we know there are so many moving parts. I was just listening to a conversation before this. There are n number of moving parts when you look at US or China or even the European nations. I'll be more comfortable talking about India's capex or India's strength in terms of discretionary consumption rather than taking global trade. So yes, we might be very gradual underweights over there, but the bulk of the investments that we do are more towards domestic-centric themes.
Indeed, you've been maintaining that for a while, and it's worked very well for all your investors. Any new ideas, Devang, from Spark Private Wealth Management that you'd like to share?
So I think going into 2025, I would probably share certain themes and certain sectors. I think the themes that you rightly said that has worked so far has been energy efficiency, power automation, which we are still bullish on. Honestly, some of the companies that we picked up in the past 3-4 years have become 10x, 12x, and all thanks to the market rally as well, of course. But from here on also, if I dissect the market cap, I think there are a lot more opportunities below 1 lakh crore of market cap, and there are emerging sectors. As we talk, I think there are so many new listings. I'm not getting carried away by the listings, but there is a plethora of opportunities available right now if somebody wants to sort of build a portfolio. And by new age businesses, I'm not meaning businesses who are sort of burning cash. But companies in the automation universe, companies in stamping and lamination, companies I mentioned on a couple of shows back about air compressors, companies like Ingersoll Rand or LG Equipment or Kirloskar Pneumatic, not recommending, but some examples of those. PT Engineering, which is into stamping and lamination. This type of companies, I think, are taking center stage. There are supply chain, TVS Supply Chain is another company which probably should be sort of looked into. I'm not again saying that we are recommending that. Port infrastructure is something which is developing very well. So there is a company like JSW Infrastructure, which also is honestly doing a lot more sort of a work in terms of setting up infrastructure lines for ports as well. And I think it's getting a lot of minor ports into its custody. So I think these are type of businesses which are high in terms of ROE, ROC. These are businesses which are sort of no-debt businesses. These are companies which are growing their profitability at more than 20-25% EBITDA, PAT. Everything is in line, and these are companies which probably have that type of moat and a huge market share. I think these are sectors one should look into if one has a 2-3 year horizon.
So Devang, you've spoken both about new age as well as some of the old world economy stocks. Now, apart from that, one particular pocket of the market that's not done very well in the last couple of years has actually been the banking pack, especially private financials. Going into 2025, is that one particular space you'll look to nibble in?
I think, see, the problem with private financial has been there is too much of perfect competition as we talk now. Again, I know that it has been a crowded trade the last 2-3 years, and I probably take a bit of pride by saying that we don't own the typical large banks. And why I say that, because yes, we know that the NPA problem has got cleared out, be it private, be it PSU, and I think the banks are all ready with fuel to lend to the new age sectors and the sectors which need sort of a lot of investments, be it semiconductor, be it EMS, all this type of companies. So my sense here is that I would love to be into proxy plays where the lending happens rather than the lenders itself. By saying that, I'm no way saying that banks are under-owned right now as we talk. It has been an over-owned space. The valuations have sort of become reasonable. There can be a trade for the next 6 months, 1 year, which can happen. But as I said, somebody looking out for alpha sectors or companies where the themes would emerge. The next 3-5 years, headlines would have companies or sectors which probably I talked about. So that will be more comfortable over there rather than putting it into a very, very simple sort of banking play.
Devang, thank you for joining in. Wish you a very happy new year and look forward to chatting with you more often in 2025. Enjoy your night. Get into a break. On the other side, the management of Zen Technologies will join in to talk about their outlook for 2025. Welcome back. Now, Zen Technologies has been one of the biggest wealth creators of 2024. The stock has rallied 200%, and it's backed by an improving revenue growth trajectory. Just look at the numbers. In FY23, the company's top line grew by 200%. In FY24, it's gone up by 166%. And there are some estimates which suggest that in FY25, also the company will see its revenues go up by more than 100%. Ashok Atluri, Chairman and MD at Zen Technology, joins in to talk about the year ahead for us. Mr. Atluri, thank you very much for joining in. That's the first question, right? Do you think, given the visibility, the order book that you have, your revenue growth can be 100% in FY25? That's the current year, because only 6 months are left, in fact, less than that. And for FY26, what is the kind of visibility that you have?
So FY25, we have promised, 900 crores as a target. We seem to be online with that, 430 crores previously, now 900 crores. And we have said that on an average for the next 3 year, growth would be about 50%. So, give or take, we are still hopeful that we would be able to achieve that on an average. I mean, 1 year may be down, the other year may be up, but overall, we are very, very optimistic about the next 3 years. And we think that government's policies are really, really pushing us in that direction, asking us to innovate, and they're buying very innovative guys. Even if you're a single vendor, they're willing to buy. The legacy of having 3 vendors, etc., is gone. So companies with patents and innovation are really, really benefiting. And then, as you know, the IP play, and, we are really benefiting from that outlook of the government,
So 900 crore revenue guidance stays for this year, 50% revenue growth CAGR for the next 3 years. Now, your margin guidance was 35% for FY25. Is that on track? And over a 3-year time horizon, given the kind of innovation that we're doing, the operating leverage which kicks in, do you think there's scope to expand margins from 35%?
So we do think there will be expansion of margins, but we are also thinking that we'll be aggressively spending on R&D and developing more products. So, we would like to stick to the guidance of 35% EBITDA margins for the next 3 years also.
Okay. And what is your R&D spend today? And you said you want to use, you want to scale that up as the company continues to grow. So do you have a number in mind?
Typically we have been doing around, earlier we were doing about 20 crores, but this year onwards it will be between 30 to 40 crores. And we expect that to ramp that up, and, maybe in the region of 50, 60 crores is what we expect R&D expenditure to go. I wouldn't like to relate it to a percentage of sales, which is actually a very foolish thing. It is a percentage of the kind of opportunities that come ahead that we want to focus on. And we'll be very opportunistic, and we want to invest in very, very high growth areas, especially in defense, which we see, and because with our ground to the year, we know where exactly to invest, and we are going to take advantage of that.
Mr. Atluri, so you've given us a couple of numbers. Number one, over the next 2 to 3 years, you see a 50% revenue CAGR. As far as operating margin is concerned, expected to be northwards of 35%. And we also believe the guidance you've given earlier is that 25% as far as the PAT is concerned. Now, one important aspect to ensure that these particular targets are met is the fact that you need to have very steady order inflows. H1 was quite muted, for the entire space. So H2, how has it panned out so far? And as far as FY26 is concerned, now where do you see the important triggers or important order flows coming in?
So I think I agree with you that the order inflow hasn't been so good in the H1, but H2, especially Q4, we are very, very positive that the order flow will be very good. And I think with the order flow coming in, even if there is a spillover into the next year, we expect the execution to start during FY26. And again, as I said, it's an average growth rate we are talking about, not a year-on-year growth rate. So, even if something happens, we are very sure we'll be able to catch up later.
Mr. Atluri, internally, what kind of order book or order inflow were you anticipating for FY25? And in case there is a spillover, what percentage do you expect to spill over into Q1 or Q2 of FY26?
Very, very difficult to say that. I think as of now, we feel that we are on track to get the orders that we had assumed to be getting during the financial year. But if there is, again, what I'm saying is, even if it gets spilled over, the execution we'll try to execute during the current year itself, or the FY26 itself. So The execution timeline, we typically are between 6 to 18 months, but we'll try to compress that execution cycle. But again, as of now, the things look very, very good.
Okay. Can you talk about, I think you had indicated that the company is looking to capitalize on the US opportunities along with domestic acquisitions. Is there any update on that? Any more details?
No,
Can you
again, we are very, very positive about the US opportunities, and with the government now really going after efficient procurement there, the days of primes being given the businesses and the other innovative companies playing second fiddle is over. America is going to buy directly from companies that innovate. And I think we have been to some expos there, and we feel that we are absolutely in good form. And what they want is something we have. And I think that's one area of growth. The US is as one key market that we look as giving us a lot of opportunities as we go ahead.
Mr. Atluri, two questions. Number one, recently you did a partnership with AVT Simulation, where we believe they will help you explore or access the US market a little better. So number one, can you quantify the opportunity size for us? And number two, as far as the recent QIP proceeds are concerned, you indicated you will look at M&A. Any targets that have been identified, any names you could share with us? And what stage is this particular M&A activity at?
So AVT Simulation is a company that's has done some work in air simulation, and we are looking to collaborate with them in air simulation for the Indian market, and they also are long-term players in US market, and they have some ready-made facilities that we can use as a made in America requirement, the value-add requirement. They're willing to share with us. So they will also have the connections to give us faster access to the US market. So I think it's a very balanced relationship that we're expecting from them. And I wouldn't put a number on it, but we should remember that they almost have a $4 billion training market there for the products like what Zen has. And I think, and in terms of our Zen's products, I think we were absolutely number one in many categories. And we think that that's one market that we'll be tapping. Of course, AVT, and without AVT also, sometimes as a prime, sometimes as a subcontractor. Yeah, and with respect sorry.
Do you have enough capacity to cater to this kind of 50% revenue growth year after year?
Yeah, so absolutely. I mean, our superpower has been the manufacturing has been done through our supply chain, and the supply chain has enough capacity to accommodate this growth. Okay. And a lot of people ask this question: 60 crores in 22, or 160 crores in 23, 430 crores in 24, and now you are saying 900 crores. Till 24, how much did you spend on capex? Actually, the answer is it was close to zero, because all the scaling up took place because we had good set of supply chain. And again, for this year now we're actually, because we do the final integration and software testing and loading into the system. That's the ground space as we are run out of the physical space, and we are building the additional space to accommodate for the future growth of 50% growth rate. And with respect to the second question about QIP, yes, we have, as I said earlier, that we have identified some companies and they are doing. So we expect maybe in the next 2 quarters to announce at least a couple of acquisitions. So we are very positive about that, but let us hope that this, till the thing happens, it doesn't happen. So we'll wait till actually we sign on the dotted line.
Thank you so much, Mr. Atluri, for joining us and giving us a sense of what to look forward to in the coming year. It's been a significant wealth creator, and we wish you and your team a very happy 2025. Well, moving on, as we slip into a short break, here's some good news for our viewers. India's business news leader is now a click away, introducing CNBC-TV18's all-new app. Get instant access to breaking news, in-depth articles, and financial world updates at your fingertips. Download the CNBC-TV18 app now from the Apple Store or Google Play Store. Welcome back to Trading Hour. Well, aero components manufacturer Unimec Aerospace listed on D Street at a whopping 85% premium to its issue price of 785 rupees a share. Earlier today, we spoke to Anil Kumar, the chairman and managing director of the company, and discussed their post-listing strategies. Let's listen in.
From a revenue point of view, we, as you see on our DRHP, we've booked about 120 crore in the first half of the year. And usually second half of the year is always better in the nature of business that we are in. So while I would say you would have a decent growth compared to the last year, and especially with the capacity that we have installed recently, and the utilization is picking up, and for investors, definitely it's going to be a gain, I would say, from a, the revenue, the business performance point of view. We are already in the process of growing our business in the domestic domestic world, especially the Indian defense is is picking up. There's a massive opportunity that we have yet to grab, and also the nuclear sector with the the nuclear power capacity demand increasing from at least 3 times from where we are now. So we want to kind of capitalize the opportunities in the nuclear and defense segment, and also to an extent space segment. So we are definitely looking at expanding to Indian market.
The last IPO of 2024, and what a blockbuster one it's been, still holding on to all its gains, 70% higher. For the markets in the red, but not by a whole lot, just down close to about 0.25%, 60 down on the Nifty, Sensex declining by 250 points, Midcaps faring a little worse. So that pullback, the recovery that we've seen from lows is still holding. It's a wrap on this show. Don't go anywhere, because on the other side of this break is Halftime Report.